Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The US dollar is on the rise, stock indices have picked up, gold is holding steady, and Bitcoin has lost confidence. The hawkish surprise in the latest FOMC minutes helped the US dollar. Members wanted to see more progress towards the 2% inflation target to resume the rate cut cycle. In their view, the risks of a cooling labor market have decreased, while the dangers of increased inflation remain high. However, investors were much more impressed by the wording suggesting a possible increase in the federal funds rate if inflation does not slow. The futures market lowered the chances of the Fed easing in April from 25% to 21% and in June from 63% to 61%. Coupled with a 0.6% increase in core durable goods orders in the US in December, this allowed Euro-USD bears to launch a new attack. At the same time, the futures market remains confident in 2 Fed rate cuts in 2026 and prices a 40% probability of a third. This situation suggests a bullish outlook for the euro in the medium term, even though the dollar's prospects in the near term look more favorable. That is, of course, unless the mood of Euro-USD fans is dampened by the story of Christine Lagarde's early resignation. Rumors have spread across the market that she will leave her post before the new elections to give the current President Macron more room to choose a successor, as she's afraid that the next president might be from the right-wing party, which may damage the authority of the central bank and also the euro. The Nasdaq Composite is poised to end its longest streak of weekly losses in 4 years, thanks to renewed investor interest in technology giants that have fallen significantly in price. Amazon's price-to-forward earnings ratio has dropped to 25, a 17-year low. Nvidia's price-to-earnings ratio recently plummeted to its lowest level since the US imposed tariffs in April. At the end of 2025, the inflated fundamental valuations of the Magnificent Seven companies and fears that they would be unable to generate adequate returns on their colossal investments in AI triggered a rotation in the US stock market. However, if the tech giants continue to spend money on artificial intelligence, it means they have it. UBS estimates that Amazon, Meta, and Google will invest $360 billion in 2026 to build data centers and other AI-related capital expenditures. Doubts about the rotation between the US and other stock markets supported the S&P 500. According to the Treasury Department, non-residents invested $1.55 trillion in US securities in 2025. This is more than the $1.18 trillion invested in 2024. Gold continues to fluctuate around the $5,000 per ounce mark. The precious metal's resilience amid hawkish rhetoric in the January Fed meeting minutes, the strengthening of the dollar, and the rise in US Treasury yields are instilling confidence in gold bulls. According to major banks, the uptrend is not mature enough to reverse. ANZ has raised its gold forecast for the end of 2026 from $5,400 to $5,800 per ounce. The company points to continued political and economic uncertainty. The impact of tariffs on the slowdown in global economic growth has not yet been fully felt. There are doubts about confidence in the Fed. This backdrop creates the conditions for a recovery in the bullish trend on gold. JP Morgan asks the rhetorical question: what will force central banks to stop buying bullion? Gold accounts for about 47% of the reserves of developed countries and only 19% of those of developing countries. Geopolitical risks keep arising with no end in sight, and as long as this situation persists, demand for precious metals will remain high. The decline of Bitcoin from its October highs was accompanied by an outflow of $8.5 billion from Bitcoin ETFs and a 2/3 reduction in open interest on the CME compared to its peak at the end of 2024. Cryptocurrency on Coinbase is consistently trading lower than on Binance, indicating its flight from the US. Disappointment appears to be the main reason for the collapse of digital assets. Investors bought Bitcoin as insurance against inflation, a hedge against the devaluation of fiat currencies and stress in the stock market. However, as it turned out, Bitcoin can fall against the backdrop of rising US stock indices, or together with the US dollar. Expectations for the integration of cryptocurrency into the financial system have not been met. Confidence has declined, and it has ended up in the red. Even a bull like Standard Chartered has been forced to lower its year-end forecast for BTC from 150,000 to 100,000. In the last week of February, investors will continue to focus on geopolitics. The U.S. has concentrated its largest military armada in the Middle East since the invasion of Iraq in 2003. If no agreement is reached with Iran on its nuclear program, the risk of a joint military operation with Israel will increase sharply. This will push up oil and gold prices amid fears for the global economy and growing demand for safe haven assets. The Supreme Court may rule on the legality of the White House tariffs on the 24th or 25th of February. The first date coincides with Donald Trump's speech on the State of the Nation. As a rule, some judges are present at this event. The cancellation of import duties would be a shock to the financial markets. One of the beneficiaries could be the US dollar. Noteworthy events on the economic calendar include the release of data on German and Australian inflation, US producer prices, and GDP in Canada and Switzerland. The Lunar New Year celebrations are coming to an end, and the return of Chinese speculators to the gold market could be a tailwind for the precious metal. Follow the updates on global markets in Pro News Weekly. Like, share, and subscribe.